Hello and welcome to this video on borrowing to invest in shares. My name's Wylie. I'm an academic, an educator, and an investment consultant to wealthy families. You probably know that already, so let's just jump into it. Here we are. Here's how to contact me at the Melbourne Business School or at Windlestone. Don't hesitate to do that. It's always good to talk. So borrowing to invest in shares. Most investors don't borrow to invest in shares. They borrow to invest in property. And borrowing to invest in shares is in general high risk, high return, but sometimes it definitely has a role. It has a role if an investor has a risk gap to close. They're too far to the left on the risk spectrum compared to where they should be. And that actually happens to quite a lot of investors. And it's also true that borrowing to invest in shares converts, or debt in general, converts income into capital gains, because income is taxed at a much higher rate than capital gains in Australia and in most other countries. And so this really helps in tax planning. So we're going to talk about the advantages of using equity in a family home, a principal place of residence, to borrow to invest in shares. And we're going to look at an example of that, work through a case study. Then we'll have a look at some problems with the alternative of using margin loans to borrow to invest in shares. And there's big problems with that. And we'll look at the problems associated with another alternative, which is using leveraged exchange-traded funds, although there is a role for leveraged exchange-traded funds, and we'll talk about that. So even though this is in general risky, the risk doesn't have to be too high because leverage in borrowing to invest in shares doesn't have to be too high. So we're going to work through a case study. We're going to look at Grace and Jasper's situation. So they are professionals in their early 50s. They're on the top tax rate. Their children are nearing the end of school, so now they've got more money to invest. They've got a home with no debt. So most of their investment journey has been paying down the mortgage on their home. They've got a lot of equity in their home. They're on their way with super. They own some shares worth 200K. Are they in a family trust, or are they held directly or in their super? Well, we'll come to that. They're outside of super. So they are focused. They've been focused on paying down their mortgage, and that's put them too far to the left on the risk spectrum. Paying down debt moves you to the left on the risk spectrum. It's a reduction of risk, and that's what most of their investment journey has been. So they should be taking more risk, and they're going to borrow to invest in shares to do that in this example. So let's just remind ourselves about the risk spectrum. So balanced is in the middle, and then we have the more extreme positions on the right and the left. Over here, we would be invested mostly in defensive assets or entirely in defensive assets, in bonds and cash. And here there'll be a mixture of defensive assets and higher risk assets like shares and property, and alternative assets like private equity and venture capital and infrastructure, etc. And over here, it'd be all risky assets and with a good degree of a good amount of leverage, or a high amount of leverage. Now, where you should be on the risk spectrum is really driven by these 5 factors. How stable is your income? Because the more stable your income is, then the more risk you can take in investing. How young are you? The younger that you are, then the more time you have in your investment journey to adjust to any shocks that you're hit with. So Grace and Jasper are fairly high in terms of income stability. They're not very old. They don't have any exceptional obligations. They have normal familial obligations like parents and children, but they don't have any exceptional obligations. They're not especially risk averse or risk loving. And they are developing a good amount of risk, so they could take a hit to their wealth. And their wealth they're accumulating a good amount of wealth relative to their goals. So these things put them here on the risk spectrum. Exactly how we would map from these characteristics onto the risk spectrum. That's the kind of thing I talk about in my investments course, or one topic that's covered extensively in my investments course. Now, when they bought their first home, they borrowed a lot of money, and that put them a long way to the right on the risk spectrum. They didn't have many other assets at that time. They borrowed a lot of money. That puts you out here. And then over time, they moved to the left on the risk spectrum as they paid down their mortgage. And they could have stayed here because this is where they should be. They moved down to where they should be, but they made the mistake that many investors make, most investors in fact, of thinking the best thing to do was to pay down their mortgage from that point. And so too much of their investment journey, really the largest part, has been about paying down their mortgage. And as I said, paying down debt is moving to the left on the risk spectrum. And so now they've got this big gap between where they are on the risk spectrum and where they should be on the risk spectrum. That's what I mean by they've got a gap to close. And they're going to close that gap between where they are and where they should be by borrowing to invest. And by borrowing to invest in shares in this case. They could borrow to invest in property, of course, but this is what we want to talk about in this video, borrowing to invest in shares. And they're going to use the equity in their home for that purpose. Now here I'm just going to run a short ad. Don't run off and make a cup of tea. I'm just going to run a short ad for my Finance Education for Investors course, which is coming up shortly. It's coming up starting on the 13th of October. It's all about empowerment in your investing and getting to better outcomes. So it's investment process knowledge, a guided self-examination of your investing, finding out what's right and what's wrong about your investing, and as I said, a structured and guided examination and opportunity to fix what's wrong about your investing. It's very modestly priced relative to the return on an investment. Most people are sort of 100x or something over that on over their investment journey on the basis of having taken this course. It's everything that you need. It is. It's all online. It's on demand. We have 6 sessions that are live to answer any questions that you have. You work through a workbook. There's plenty of materials. There's one-on-one discussions with me. It starts on the 13th of October. The materials are 100% on demand, so you can work through them at your leisure. But we do have 6 live Q&A sessions to answer all of your questions. So, people absolutely love this course, I say without a hint of modesty. Now go to windlestone.com and do that soon because it is coming up. If you're watching this video sometime in the future, the course does come up every 6 months, but it's coming up right now, and now's the time to do it. All right, back to Grace and Jasper. They're borrowing to buy shares. So they've got 200K in shares, and they're holding those shares directly. We'll talk about why they're not holding them in a family trust and whether they should be holding them in a family trust in just a bit. In general, you should be holding a tax advantage structure like a family trust or a corporation or a superannuation fund. But they're not doing that, but we'll talk about that in just a moment. They want to borrow 400K against the equity they have in their home to increase their portfolio to 600K to help to close the gap that we were talking about before on the risk spectrum. What are their borrowing options? Borrow against the equity in their home, use a margin loan, a geared ETF, and we're going to come to comparing these. But mostly we're going to be talking about this, borrowing against property. So, but before we do that, we're going to need to talk about the ASX 300 for a bit here. So I'm going to take you through the expected return on the ASX 300 and why the components that I've chosen for the expected return on the ASX 300 sort of match the historical record and what we should expect in the future. Okay, let's go with this. I'm going to say that we should expect a total return of 9.4% on the ASX 300. Now, where did I get that from? Well, this is what I mean by the historical record. This is taken from the UBS Global Investment Returns Yearbook. This is the work by Elroy Dimson and Paul Marsh and Mike Staunton. Elroy was my thesis advisor when I did my PhD at the London Business School. In any case, so I borrowed this from his book. I'm sure he won't mind. So, but this shows if we look back over the last 125 years, that the real return on Australian shares, so this is with inflation taken out, the real return on Aussie shares after inflation or above inflation, 6.7%. The real return on long-term treasury bonds, 1.5%. And this market risk premium, as we would call it, the extra return that investors have received in the past and expect in the future for taking the risk of the stock market, the market risk premium, 5.2%. So that's one thing that we could start with. Now, what should we expect in terms of long-term bonds? Well, we can just look at Bloomberg for that. And we can see that the yield on long-term bonds in Australia today, 10-year bonds, which is what Elroy is using here, is 4.4%. So let's put that into our graph, 4.4%, the yield on government bonds. And then we're going to add this risk premium on top of that, 5.2%. That gets us to 9.6. Now, we could have just said, okay, well, what do we expect inflation to be in the future? Let's take the midpoint of the RBA's range for inflation between 2 and 3%. So we're expecting inflation to be 2.5. And then we're expecting, if the future is like the past, that we're going to get 6.7% above that. So that'll give us 9.2%. So my 9.4% is the average of these two ways of getting to an expected total return on the share market in the future. So 9.4%. What are the components of that 9.4%? Well, dividend yield is 4%. Where do they get the 4% from? Well, here's the dividend yield on the ASX 300. Over the last 45 years, it's actually averaged a little over 4.1%. But let's just go with 4%. And then the ASX 300 is 80% franked. So franking credits, that works out to be 1.37%. But I'm just going to put 1.4 here. And the rest is going to be capital gain. Now, we shouldn't be surprised that the capital gain here is 4%. You know, if you look at the capital gain on shares in the ASX 300, or the capital gain in the ASX 300 over the last 25 years, that's been 4%, 4.1%. So we shouldn't be surprised by that. So these are the components of our expected total return. Now, what do we expect to get here in terms of after-tax return? So the capital gains is going to be applied, the capital gains tax is going to be applied to capital gains. So that should be a half of their marginal tax rate, a half of 47%, so 23.5%. But because they're going to delay the payment of capital gains, their effective capital gains tax rate is going to be 20% and not 23.5%. So they would have to delay the payment of capital gains for 10 years. They'd have to hold their shares without trading them on average 10 years, but that is what they're planning to do. They've got a long-term passive investment strategy. And so this is going to be, the government is going to end up with 20% of this return because they're going to hold the shares for 10 years and the delay of the payment of tax is going to reduce the effective tax rate. This is something, again, comes up in my videos from time to time and certainly in my investments course. So 4% down to 3.2%. Over here, they're paying 47% on the grossed up income. So that's down from 5.4 down to 2.8. Put those two things together, we've got 6%. And after expected inflation, an expected real return of 3.5%. So this is without leverage. This is, you know, putting $100 into the ASX 300. This is what we would expect to get. Expect to get $6 per $100. And once we take out the effective inflation, $3.50 real return on our $100. Okay, let's move forward from that. Just noting that our effective tax rate in going down from 9.4 to 6% is 36%. It's a blend of the 47 we're paying here and the 20 that we're paying up here. We'll come back to that in just a moment. So now we're going to add some leverage and we're going to borrow $2 for every dollar that we were investing previously. Here we're investing $100. Now we're going to add $200 that we borrow, or Jasper and Grace are going to add $200 that they borrow against the equity in their home. And it's going to supersize their returns. They're putting in $100, but they're going to get the returns on $300. So as I said, it's going to supersize it in all of these, dividend yields and franking credits and capital gains. But of course, they're going to have to pay interest. They're going to have to pay 5.5%, which on the $2 for every $1 of equity that they put in is going to turn out to be 11%. So where do we get the 5.5%? You know, the 11% here is relative to the $100 they put in and the $200 that they're borrowing, but it's an interest rate of 5.5%. Why are they borrowing at 5.5%? What's the reasoning there? Well, it's this. Inflation is expected to be 2.5% in our model here. We're thinking that the real interest rate's going to be 1%. We don't know whether we are going back to the circumstances, the pre-COVID circumstances of real interest rates being close to zero in that deflationary environment pre-COVID. People forget that the cash rate was cut to 0.75% months before the first case of COVID appeared in Wuhan. But so there was a powerful deflationary environment and a real interest rate of zero before COVID. But before the GFC, real interest rates were above 2.5%. So we don't know whether we're going back to the pre-COVID conditions or pre-GFC conditions. But look, that's the subject of another video. But let's just go with the midpoint between those two. So we're going with the real interest rate of 1% here, but that really matters. And as an investor, there's no way of not taking a position on this, but I'm just going to go with 1% here because it's not really the center of what we're talking about here. And our bank margin, 200 basis points. So the cash rate, expected inflation plus the real interest rate, 3.5. And the bank, we're taking a relatively low LVR loan for investment. We're going to want to have an interest-only loan. So it's going to be about 200 basis points. All right, 200 basis points. So 11% when we sort of supersize it with the $2 of debt for every dollar of equity. This is the income that we have that we're going to be taxed on. This is the capital gains. Our capital gains is going to be taxed at 20%, so this is going to be down to 9.6 relative to the $100 that we put in. Our incomes are going to come down here. We got 12.3 and a real return of 9.8. Now, this is the return on the $100 that they put in. And the reason that the return is so much larger than it was before, because this is 3.5 before, is for two reasons. One, because we borrow to invest, so we're taking more risk, so it's higher risk, higher return. But there's also a tax reason why this return is higher. It's not just that Grace and Jasper are taking a lot of risk. There's also a tax benefit, as I was saying before, from borrowing to invest. And let's look at what that tax benefit is here. So we're just going to compare their return when they were investing $100 with no borrowing, and now investing $100 with $200 borrowed against the equity in their home. And when they had no borrowing, they had an expected return of 9.4%, which went down to 6% with a 36% average tax rate across the 20% on capital gains and the 53% or the 47% on income. And then when they borrowed money, this of course got supersized. It increased by a factor of 3, because now we're investing $3 for every dollar that we were investing previously, with two of them coming from the bank. So all of this is being supersized. We've got to take out the payment of interest that's coming out from the supersized dividends, of course, and then this gets reduced to 12.3%. But 17.1 down to 12.3 is a 28% effective tax rate. So once we borrow the money, what's happening is that income is getting turned into capital gains. You see, income is getting used up in supporting the debt. And what's left over is the supersized capital gains, which is being taxed at 20% effective tax rate because they're delaying the payment of capital gains for 10 years. And so we're basically turning income into capital gains and getting to a lower effective tax rate. So this higher number here isn't just about the extra risk. This higher after tax number isn't just about the extra risk. It's also the lower effective tax rate, which is coming from a higher proportion of the return being capital gains because income is being used to support the debt. And it's not capital gains that's being used to support the debt. Borrowing turns income into capital gains. Now that's true, of course, in borrowing to invest in property and other assets, just as it's true in borrowing to invest in shares. And it's a really crucial part of investment strategy, but not a very well understood part of investment strategy. It's not just the fact that borrowing to invest is leverage is increasing, moving us to a higher point on the risk return spectrum. There's a tax reason as well. Okay, let's keep moving along here, and let's go back to Grace and Jasper. And so they've already got $200 in Aussie shares, and now they're going to add this $400K that they're going to borrow against their home. So here's Grace and Jasper. They've got a $2.8 million property. They've got a share portfolio of $200K already. When they bought their property, it cost them $1 million, and they borrowed a lot of money at that time. That was a while back. They borrowed a lot of money, but over time, the value of the property increased and they paid off all the debt. That's been their investment journey. That's why they're so far to the left on the risk spectrum. That's why they've got a big gap they need to close. Now, look, they could close that gap by borrowing to invest in property. And why they've chosen not to do that, well, we don't know, right? It might be that they already feel like they have enough property, enough exposure to property. Maybe there's something else going on in their portfolio that I haven't mentioned. Maybe it is that they feel that the property market is overvalued, but they've chosen to borrow against the equity in their home to invest in shares. Okay? Or we could have put some extra property into the example, but I just want to keep it straightforward. So they're going to borrow 400K against the equity in their home. And then they are going to add that to their share portfolio. So they're going to invest it in ASX 300 exchange traded funds. So instead of having 200K of exposure, now they've got 400K of exposure, and they're going to earn the returns, the expected returns that we were talking about before. So this is them implementing their strategy. Now there's a few questions we should ask ourselves here. So one is, wouldn't it be better if they held these shares in a family trust? Because that would give them a lot more flexibility. It wouldn't cost that much to set up the trust. This is plenty of money to make it worthwhile to set up the trust. It's not very hard to run. It's not rocket science. They could distribute the income. There's not really a lot of income here, but there will be over time as the value of the shares go up. They could distribute the income and store it in a corporate beneficiary. Then maybe later on when they retire and they have low marginal tax rate, they can send the money up from the corporate beneficiary, drain the corporate beneficiary. The corporate beneficiary is owned by the trust or the corporate trustee of the trust. And so they can send fully franked dividends out of here and distribute them to themselves. Later on, store it here until they're retired and they're on a low tax rate and send it out here. Yes, well, that would be very natural strategy, a very natural thing for them to do. Now, another question is, couldn't they borrow a lot more money? Instead of borrowing $1 million, instead of borrowing 400K, couldn't they borrow $1 million? Well, they could definitely do that. But now it would be negatively geared. Now the interest would exceed the income here. And so they would have to have income inside the trust to offset the loss here. Now they may well have that. They may have income from other sources inside the trust. Maybe they got some property or other assets. Maybe they got some bonds to do that. But most likely, if they were going to do this, if they're going to borrow a lot of money and go into a negatively geared situation where the debt, the servicing of the debt exceeds the income from the shares, then they would want to hold it outside of family trust. So they could combine it with their income, just as the negatively geared property is it's typically held outside of trust structures. So they would do that. We could also ask ourselves, well, couldn't they invest in US shares instead? And of course they could, and they would have a lower yield, and so even at lower levels of leverage, it would be negatively geared. But that might work for them, and it is an even more extreme example of turning income into capital gains. Income, their labour income, their employment income that would otherwise be taxed at 47%, is going to supporting the shares, and especially if they're US shares and they have low dividends, and turning that income into capital gains. So there's both a sort of investment strategy and a tax strategy going on and working together here. All right, they're all good considerations. Now, the next thing we want to do is look at broker loans, at margin loans, and then look at geared ETFs. And I'm going to have a pretty dim view here on margin loans, and a more positive view on geared ETFs once we get through that, certain types of geared ETFs. So a margin loan, problems with a margin loan. Let's just take an example here. Let's say that we want to borrow $1 million, or we want to invest $1 million in shares, and we got 350K of our own money. We're sort of moving away from the Grace and Jasper example here. 350K of our own money, and we're going to borrow 650K from our broker here. And so this is the buffer that the broker wants us to maintain. This is how much the shares would have to fall before the broker is in danger of losing money, assuming that the shares fall smoothly and they don't just sort of jump down overnight down into here. But if the shares move down slowly, then the broker can insist that we re-establish the margin. The broker can give us a margin call as the shares move down and say, look, the buffer's not big enough here. You're either going to have to put some more money in, or we're going to have to sell down the shares to pay down the debt. And that's the problem with margin calls. Those margin calls don't occur if the loan is backed by property. rather than being backed by the shares themselves, then we don't get into destructive margin calls. Now, what do we mean by destructive margin calls? Well, from time to time, the market falls a lot. It fell 53% in the GFC, fell 37% in the COVID crisis. And when it falls, with a margin call, you're forced to sell at the bottom of the market. You either got to put more money in, and where's that money going to come from? Or you've got to sell down the shares to repay the debt. As this starts to move down, as the market starts to fall, you are more and more selling shares rather than buying shares towards the bottom of the market. Now, look, if the market went down and stayed down forever, you'd be glad that you were stopping losses and selling on the way down. But that's not what you're expecting to happen. What you're expecting to happen is from time to time, the market will fall a lot and then it'll rebound. And what's happening here is with your margin loan, with a big margin loan, with a high level of leverage, is that the bus is slowing down, you're getting off, and the bus is speeding up again. The bus slows down, you sell out, and then the bus speeds up again. Now, this happens from time to time, a couple of times in every generation. A set of investors get wiped out because of that, because they haven't followed the maxim, the really crucial maxim for investors, that it's good to borrow to invest, but you need to be able to survive the inevitable downdrafts that occur in the underlying asset. Now, that's true of property and other asset classes as well as shares, but it's especially acute in shares because shares are so volatile. That if you have a lot of leverage in borrowing to invest in shares, then how are you going to manage that problem? Well, one way to manage the problem is to not have the shares themselves as a security. This is what Grace and Jasper are doing. They're not using the shares as security, they're using their home as security. So no matter how much the market moves, they're not going to get a margin call because it's not the shares that are the security. So they don't have that problem. But investors need to be acutely aware. It's great to borrow to invest. It means that instead of your investments growing like that, they grow like that. The higher expected return. But it's absolutely essential that you think forward and reason backwards as to what are you going to do when the inevitable situation of the underlying asset falling a lot in value forces you out of the market at the bottom of the market. How are you going to make sure that that doesn't happen to you? Okay, so a big problem. Now, another big problem with margin loans, of course, is that interest rates are very high. So I don't mean to pick on CBA and NAB here. That was just easy to grab this data from their website. But you can see here, we're 400 basis points above the cash rate, more than 400 basis points above the cash rate. Here and over here. Very high interest rates. Very high spreads. Jasper and Grace were expecting them to pay 200 basis points above the cash rate. And here we're paying a lot more than 400. And over here even more than that. And these have relatively low margin call rates. So, margin loans, I don't like margin loans because we don't like margin calls and we don't like high interest rates. Now, what about geared ETFs? Well, they also have margin calls if they have a lot of leverage and they have relatively high fees. So we could have a ETF where we put in 40K and then the ETF borrows another 60K. So here we have, an LVR of 60% in the ETF. Now, it's the same problem, right? That if the market moves down a lot, then whoever's lending the money to the ETF, it's usually the prime brokerage desk of a investment bank, but anyway, that's not the point. The point is whoever's lending the money to the exchange traded fund to borrow to invest in the geared ETF, the ETF's going to receive a margin call. And when the market moves down a lot, if they have a lot of leverage, if it's highly geared, then they're going to have to sell at the bottom of the market. It's the same problem. There's no way around it. If you have a lot of leverage into shares, and the shares themselves are the underlying security, there's no way around this problem. And then another problem is high fees. So a fee of 80 basis points would be pretty typical here, but that's on the gross value of the ETF. So 80 basis points on the whole of the ETF is equivalent to 200 basis points on your 40% equity in the ETF. So very high fees. And I don't like either of these things. I don't like the margin calls and I don't like the high fees. But sometimes ETFs, or there are a set of ETFs that have lower gearing, and they typically have lower fees as well. So they're better on both accounts. So lower gearing, so less of a problem with margin calls, and lower fees. So now we've got less of a problem with margin calls, and we're only paying 57 basis points. This is the 35 being grossed up for the extra leverage, but modest extra leverage, modest extra gearing. And so, you know, these low geared, these ETFs with modest fees and modest gearing, they've got a real role, I think. And I don't have as much to dislike about them because they don't have as much debt, so you don't have as big a problem with margin calls. The market has to go down a lot before you're forced to sell any of the shares to meet a margin call if you have a modest amount of gearing, and they have lower fees typically. But you can't borrow as much. You see, if Grace and Jasper put their 200K into one of those, they'd only end up with about 300K of exposure. And they want 600K of exposure. So those geared ETFs are good, but they don't close the gap for them. That's the problem. They're good in terms of margin calls and fees, but they don't actually close the gap for Grace and Jasper. So they don't solve that fundamental problem for them. Okay, borrowing to buy shares. So let's just conclude here. So leveraging share investments is in general risky, but it's got a role. It's good for closing the gap. Debt converts income into capital gains. You know, it's not just that we're getting to a higher point on the risk return. It's also that there's a crucial tax strategy role here. And you know that borrowing to invest in the using equity in the home is terrific. Margin loans are not terrific. Leveraged ETFs that have a low amount of leverage can be good for some investors. And then leverage doesn't have to be high, but that's what Grace and Jasper need because they've got a big gap to close. Don't forget about my Finance Education for Investors course, which is coming up on the 13th of October. Okay, thanks for watching to the end. If you're watching this on YouTube, then don't forget to like it and subscribe to my channel. And thanks for watching. If you've got any questions, then get in contact. Cheers.